Welcome back. This is CC with Options AI. We get a lot of questions about trade management on the Options AI platform, and we're quite proud of our visual trade management. I wanted to go over a couple of ways that can potentially help you know when to exit a trade, when to stay in a trade, when to let profits run, when to cut losses. Going to use a couple examples here, both call spreads in Amazon. So you've seen on the platform by now, if you go into Amazon, we're looking at a 1 month chart. If we did an expiration out to August 29th, you could go in here, price a call spread. And once you see this call spread, you obviously see the metrics of the max loss and the max potential gain. This is a 7.5 wide call spread at the money, buying the call at the money. And the break even is up higher than where the stock is currently trading. And we have the what if engine where you can hover throughout the life of this trade and at different stock levels, see roughly what this trade would be worth. That's very good for shopping for a trade early on and going into these strikes and determining the potential risk reward of maybe selling a call slightly higher or maybe buying a call that's slightly higher or lower. What I want to show here now is going back to a couple of positions, and I'm going to compare two different call spreads. One is in the money and one is out of the money. So the first is we're looking at an out of the money call spread. This is a 235, 240 call spread bought for $1. It has the potential to make up to $4, $100, and $400 on this metrics right here. It's an 18% probability of this stock being above 240 before this expires, and a 66% probability of max loss. And that is because it is out of the money. It is more likely that this trade finishes worthless than it becoming in the money. Any move short term on this stock towards that trade is going to show mark-to-market profits right here, like we're seeing right now. However, with the what if engine, as you can see, if you go out in time, those mark-to-market profits, even if the stock went higher, using an example of the stock going to 232.5 in a little over a week, August 26th, this would actually be worth less than you paid for. It would be a mark-to-market loss if this was all the move you got in Amazon. And if you got it up towards the end of this trade, right before expiration, and the stock was at 235 but hadn't gone up above your break even, as you can see, the theoretical price on here is about $55. You're almost at a 50% loss on this trade. So you really need this stock to make a move. And therefore, if you do start to get a move early on in this trade, let's say we got this move to 235 in the next couple of days, this trade would be worth about $200 after having paid $100. But as you can see, if you went out in time, it would begin to lose money. It's decaying because it is not in the money yet. And you don't think that Amazon is going to take out these highs and it's up near your strikes, you might want to take profits. You know that decay is working against you. If the stock just goes sideways, this is going to become worth less and less mark to market. And if the stock finished at 234, just under 235, your long strike at August 29th expiration, this would be a max loss, and you would have lost all of those profits that you made right out of the gate. Now, let's go back to the in the money call spread, where you're going to see a trade that is already in the money. This is buying the 225 call and selling the 230 call. And right now it is showing a mark-to-market profit of $35, paid $3, it's worth $335, the contracts. And as you can see, using the what if engine, if you go out in time, this actually without the stock going any higher, this is actually gaining in value. This in the money call spread is not a max gain because it's accounting for the possibility of the stock going lower and this becoming a max loss or a partial loss. And so therefore, if you're in a situation where you're already in the money, but you haven't quite gotten the entire potential profits from this trade, decay and theta are on your side, and you can use this what if engine even if even if Amazon went slightly lower out here towards when this trade expires, this would have made, in this case, $115 right here on August 29th. Going out here to the end, it is almost max gain. And so decay and time are on your side. There are certain trades where if I was profitable in this out of the money call spread, if you were profitable on it immediately right out of the gate, you might want to take profits much faster than if you were in this other trade and you were profitable and the stock's not really going higher or anything, but you know that time is on your side and your risk is determined by this updated expected move. So let's say if there was an earnings coming up and you had lots of mark-to-market profits, but you saw a big wide expected move that took you lower, and this could be a max loss, well, that's something that says, maybe it's time to take the profits because I don't want to go through that earnings and risk all of my mark-to-market profits. I'd rather just book them now.